Thanks for tuning in to this week's Signature FD investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, we're going to start this week as we do most weeks with our chart of the week. And we titled this one Strength Begets Strength. And what we've seen here is we've seen a pretty incredible run for the market over about a 2 month period of time, up about 21% or so in just 2 months off of the April 8th low. And what this chart does is it takes a look at previous instances where the market was up at least 20% over a 2 month period of time. And it hasn't happened very often. You can see that the sample size was 5 before this most recent occurrence. But one of the things that you would note is the subsequent 1 year after has been quite strong. And oftentimes, I think as investors, it's a little bit counterintuitive because we're taught to opportunistically buy low and sell high. But this proves out that strength does intend or does tend to beget further strength. So new all-time highs and a strong 2 month run should not be scary to investors. Now, looking at performance year to date of various indices here, we can see that international markets have continued to lead the way. The S&P 500 has returned a very respectable 7.5% through the first half of the year, but developed international markets are up about 20%, and emerging international markets are up about 17%. Now, one of the things that has been interesting is that small caps haven't really been able to get their footing. They're only up about 1.6%, and we think that that has to do with the fact that the economy is slowing somewhat, still in growth mode, and we're going to touch on that here in a second, but slowing down a little bit, and that has more of a drag on small cap companies that are more economically sensitive than large cap companies. So when we look at the impactful data from last week, it was really all about the jobs market. And here we're showing the ADP payrolls number. That was a bit of a surprise to the downside. We can see that ADP payrolls did drop 33,000 jobs in June, which is the first contraction in a little over 2 years in that ADP figure. What drove the drop was those small businesses. So again, that is in line with the thesis that small companies are struggling a little bit more in the economic environment than the big companies. When we look at the official BLS survey, which can diverge sometimes from the ADP survey, we got that on Thursday, and that was fairly healthy, 147,000 new jobs created. Now, when we look at non-government jobs, so that metric on the bottom clip, which shows private non-farm payrolls, that did only grow 74,000 and was one of the weaker readings in the last several months. So we are seeing a slowdown of job creation, and that goes in line with a slowing in economic growth at large. And with that, we are seeing some other cracks, such as wage growth and the average work week. The average work week did contract last month, and wage growth continues to slow. And that's what we're showing on this chart here is measures of wage growth in the goods producing industries in orange, and in light blue, the service providing industries. And you can see that both of them have been easing, but notably the goods producing industries, wage growth has really been slowing down quite a bit. Now, when we look at Q2 earnings, and it always comes back to the fundamentals, Q2 earnings estimates are not very demanding, which is probably a good thing, seeing as the economy is slowing somewhat. So, at an index level, analysts are, and that's that gray bar here, analysts are expecting earnings to come in about 5% year over year for Q2. Now, almost all of that is being driven by the communication sector and the information technology sector. But nonetheless, earnings estimates are not that demanding, and we expect that companies should be able to meet that hurdle as these earnings announcements come in. Now, as we look to earnings in the second half, that's where we start to have a little bit more concern. So this chart is just showing In the bottom clip in red, it's showing nominal economic growth, the year to year change, and then it's showing the year to year change in corporate earnings in black. And you can see that there is a very tight relationship between nominal economic growth and corporate earnings. Right now, you can see that that red line, which is nominal economic growth, has been easing. And in the first quarter, it was 4.7%. Earnings in the first quarter were up over 10%. So there has been some dispersion, some divergence between earnings and the economy. And we expect that that is likely to narrow, and it might be more challenging to hit earnings estimates for companies in the second half of the year. Now, seasonality, as we look to technicals, and seasonality is one of those technical indicators that we pay attention to, but we don't use it as a major input in what we do. But we can see here these gray bars on the bottom show how the S&P 500 ETF SPY has tended to do in the different months. So it shows the average monthly returns, and it also shows the percentage of those months that were positive. And you can see that July has actually been a pretty good month for the markets with an average return of 1.3%, and 57% of July's have in fact been positive. But as we turn through July and get back to August and September and you're back to school season, August has tended to be a bit weaker than July with only a 0.38% return. And September is the only month that has averaged an actual negative return for the month. So September has averaged a negative 0.75% return, and less than half of all Septembers have actually been positive. So we are going to get through July, which is seasonally pretty strong, into August and September, which tend to be more seasonally weak. And if a correction is going to manifest, it's probably going to do so because sentiment has gotten too optimistic, or investors have gotten too complacent. So this, what we're showing here is the NDR crowd sentiment poll, and this aggregates a number of different sentiment indicators into one big sentiment composite. And we can see that just recently, investor optimism has crept up into kind of a higher risk mode for the market. It's not too optimistic right now, but if optimism continues to creep up through July, that probably could set the table for that corrective action that you do tend to see in those late summer months. So to wrap things up for this week, stocks have rallied strongly over the past 2 months. And even though it doesn't sound intuitive, that should not scare investors. Oftentimes, strength does beget further strength. Now, there are some cracks forming in the labor market, and that's very notable among small businesses. We think that we're in an environment where growth is easing, but not yet recessionary. Now, the bar for second quarter earnings is not particularly high, but analysts are likely too optimistic on the second half earnings outlook unless growth is able to pick up in the second half of the year. And seasonality is a tailwind in July before flipping to a late summer headwind here. So that's something that we're watching from a technical perspective. And what could drive that correction would be investor complacency. And we'll be watching that to flag high risks for that next correction. But the big picture is that the bull market does remain intact. So that's what we have for you this week. As always, we want to thank you for joining us, and we wish you a great week ahead.